Assalamu alaikum everyone. So welcome back to my channel Rapid Revision. This particular question is from AS Level Accounting, and this is a question on incomplete records. The question here says Rahul owns a retail business. He has not maintained full accounting records. He is able to supply the following information about the financial year ended 31st January 2024. They're saying here valuation of inventory. So they've given you inventory at start and inventory at end. And then they're saying here Rahul sells goods so as to achieve a gross profit margin of 40%. So whenever margin is given, it is assumed that revenue is 100%. Okay, so this I have taught in a lot of videos of mine that whenever margin is given, we give revenue a value of 100%. They are saying here the usual rate of inventory turnover is 9 times a year. Calculate the revenue for the year ended 31st January 2024. So if we know cost of sales, we can calculate revenue, but we don't know cost of sales. But we know one formula which is called rate of inventory turnover. So rate of inventory turnover is basically cost of sales upon average inventory. So I'm going to write here rate of inventory turnover, which is equal to cost of sales divided by average inventory. So average inventory over here, cost of sales divided by average inventory. Rate of inventory turnover here is 9 times, and the average inventory here is 21,400 plus the closing inventory, that is 19,800, divided by 2, which is going to give me 20,600. So average inventory here is 20,600. So I'm going to write here x upon 20,600, and when I multiply 20,600 by 9, this is going to be 185 400. This is my cost of sales. So this is my cost of sales. So now I know, since I know revenue is 100%, gross profit is 40%, so cost of sales is 60%. So I'm going to write here cost of sales is 60%, revenue is 100%, gross profit is 40%. So I'm going to write here 185 400 is 60%. So what is 100%, which will give me my revenue? So when I equate this with x, 185 400 is 60%. So what is 100%? X is 100%. When I calculate the value of x over here, I'm going to get here revenue, which will be 309,000. This is going to be my revenue. This is my final answer for revenue. Then they are saying here additional information. Rahul has not kept a record of his cash drawings during the year ended 31st January 2024. However, the following information is available concerning cash transactions. On 1st February 2023, there was cash in hand of $840. This is basically my balance, opening balance. So this is basically my opening balance brought down of the cash account if I prepare my cash account. But what they are trying to say here that we need to calculate Rahul's cash drawings. So Rahul, since he has taken out money from cash, so we can basically prepare a cash account, although they haven't required you to prepare a cash account. But what I think here is that preparing a cash account would be also a nice way to calculate cash drawings in this case. So when I start this T account, I'm going to write here balance brought down on the debit side, and I'm going to write here 840. So this is going to be on February 1, 2023. So I'm going to write here February 1, 2023. This is going to be my balance brought down. Then they're saying cash sales accounted for 70% of all sales. So the total sales here is 309,000, of which cash sales is 70% of 309,000. So I'm going to calculate 70% of 309,000 is going to give me 216,300. So whenever we make sales for cash, right? So the double entry is cash account, debit, sales account, credit. So I'm going to record this on the debit side of the cash account. I'm going to write here sales, and I'm going to write here 216,300. This is my cash sales. And then they're saying bank statements recorded total cash takings of 187,300 for the year ended 31st January 2024. However, at 31st January 2024, there were cash takings banked but not yet credited of 3,800. So they are basically telling you that on the bank statement, there was certain amount that we transferred from the cash account in the bank account. So that was what we deposited in the bank, right? So cash takings, normally the word cash takings means that whatever cash we have, we are putting that into the bank, right? So the cash drawer, whatever we have in the cash drawer, we are putting some amount in the bank account. So the cash takings on the bank statement is 187,300, but they have also said that there are some cash takings which were not credited by the bank of 3,800. So that means we have deposited a total of 187,300 plus 3,800. So 187,300 plus 3,800 is what we have put into the bank. So 191,100 is what we have deposited in the bank. Okay, so deposited in the bank. So this is what we have put into the bank. So I'm going to record this on the credit side. So whenever we deposit the money into the bank account, bank is being debited, cash is being credited. So in the details, I'm going to write here bank, and I'm going to write here 191,100. This is this is the amount that I have put into the bank. Okay. So this is what I have deposited into the bank. So it's not part of my, like, it's not part of the cash drawer anymore. We are putting it into the bank. Then they're saying cash was used to pay a part-time assistant wages of $320 per week. The assistant worked for 44 weeks, so 320 into 44. So 320 is what we are paying him per week, and 44 is the number of weeks that he has worked. So if we calculate 320 into 44, which will come out to be 14,080. This is the amount that we have paid for wages. So I'm going to write here wages, and I'm going to write here 14,080. This is what I have paid for wages. Then they're saying at 31st January 2024, cash in hand was 1830. This is my balance carried down. So I'm going to write here January 31, 2024. I'm going to write here balance carried down. And this is going to be 1830. So drawings is some unknown amount that I'm going to calculate from here. On the debit total, you will see 840 plus 206, 300, and this is going to be 217,140. So total of the debit side is 217,140. On the credit side, it's 191,100 plus 14,080 plus 1830 is a total of, it's the total of my credit side, 207,010. So 217,140 minus 207,10 010 is going to give me 10130. This is my total drawings. This is what I have taken out as my drawings for cash drawings for the current year, and I'm going to total this T account 217,140 on both the sides. 217,140, and this balance carried down will become my balance brought down. So I'm going to write here balance brought down. I'm going to write here 1830. This is going to be February 1, 2024. And that's it for this T account. Basically, this is what I have calculated cash drawings from this T account. In the next part, they're saying Rahul's accountant has suggested that he should start keeping full accounting records. So full accounting records is what the accountant has suggested, and that he should use an accounting software package. So it's always good to use a software package. You guys know this very well as well, that if there is technology, we should make use of technology and try to make our work easy. But if there are certain accountants these days who are still using the manual accounting, it's not logical. So since we have an accounting software package, everybody needs to adapt to the new technology that is there in that is available. So here they're saying state two ways in which Rahul will benefit from the accountant's suggestions. Possibility of improved decision making, because we'll have all the records available. Complete records give you a very clear picture of the business and a very clear picture of the performance of the business. Then they are saying information produced by accounting software will be more accurate. Accounting software will process the information faster. There will be the chances of errors through accounting softwares will be reduced. If we have full accounting records, we'll have improved decision making. However, in the last part, they are saying explain two possible reasons for not accepting the accountant suggestion. Number one, there are costs associated with installing an accounting software. So when you install an accounting software, the accounting software itself, you need to pay for it. The cost of the package itself plus the maintenance cost, maintaining the package, and then also the cost to train the staff for using the accounting package is also going to be a cost for the business, for Rahul's business. The next reason why Rahul will not accept the accountant suggestions is maybe Rahul is very satisfied with keeping incomplete records. So he does not want and he does not need complete accounting records, and he feels that he's okay, and he feels that he does not have enough time. He may feel he does not have enough the time and the skills to use an accounting software, and he does not want to keep full accounting records. So because he's satisfied with incomplete records. So so that's it for this question. Thank you so much for watching.